I want to talk to you about the mathiness, which you're really quite good at, of the market right now. Is the volatility that we're seeing right now normal volatility, or is there an unusual dynamic that you see?
Yeah, so we'd say it's been more normalized the last 4 to 6 weeks as the trade conflict has escalated. I mean, if you go back and think of 2017, for instance, we had exceptionally low volatility in every asset class. And then last year we had 2 big corrections where it got to the more elevated range. Coming into this year, once the Fed pivoted their policy to be much more easy than the market anticipated late last year, volatility collapsed once again and volatility sellers returned. So we think we're in a more normalized range here, which makes complete sense given the uncertainty around economic growth and the trade conflict.
Pull it over to the left tail of the greater financial system now. Are there instabilities out there? I mean, I'm doing one interview. I'm doing an interview with Pharaoh, and they're all optimistic, and the world's great, da-da-da-da-da, and I do the next one, it's gloom.
Yeah.
I mean, what's the left tail look like right now?
Yeah, so from our perspective, the left tail remains in corporate credit and the private lending market. So if you think of where the bad behavior has been in this cycle, it hasn't been in housing, it hasn't been in consumer lending.
Is it in high yield?
It's mainly been in high yield and levered loans, right? And secondarily in private credit. If you look at private credit, you've gone, when I started in this business in April of 2001, that was a $5 to $10 billion market.
That's just forever. It's forever ago.
Forever ago, right?
Jesus, Troy, I feel
I'm still relatively young, right? No, but now it's $1 trillion market, Tom. And,
you think that's funny, Ms. Lacroix?
No, but think of the growth in private
I shall
credit,
say nothing.
right? The growth in levered loans, the growth in high yield. And unfortunately, net debt to EBITDA levels are back near the peaks they were in the late 90s. And so if you compare this cycle
You're spending too much time at your conference. You're throwing around ratios like net debt to EBITDA.
Come on,
what
jargon
is net
term.
debt to EBITDA?
Well, you subtract out cash, right? And you look at where net debt levels are to total earnings before interest, taxes, depreciation, and amortization. It's a common term. Think of it as debt to cash flow. Is that a better metric?
Troy, Tom's just calculating how to do his next chart because he has the averages of all of that in his head, and we'll put it out shortly at Bloomberg Terminal. Troy, so just to take a step back, what does all this, QE and the everything, all the stimulus that central banks have done to that market, and how will that change in the next 5 years?
Well, look, again, if you look at corporate America, it's hard to blame corporate CEOs and CFOs for taking advantage of free money, which has been on offer from central banks for the past 5-6 years, right? And so the healthy development is as you've had better GDP growth and rates have gone higher in the U.S., leverage levels have stabilized. There's a simpler term, Tom. Leverage levels have stabilized. So there is hope that if we continue at a 4 or 5% nominal GDP level, corporate America can delever their way out of it. Our whole point, though, is if we do get a surprise recession, trade war escalates, we get a policy shift out of D.C., something goes wrong in Europe, the bulk of the pain to the downside for investors will remain in high yield and levered loans and secondarily in private credit. So that will be the pain point. It's not the end of the world. It won't cause a bear market. It won't cause a recession. But when that occurs, that's where the bulk of mark-to-market and realized losses will reside, as opposed to the last cycle, which was mainly dominated by housing and consumer credit, as you know.